GDP growth drives earnings growth in the market, and then in turn it drives the returns that the investor gets from the stocks that he has purchased.
Hello everyone and welcome to our channel, The Mutual Fund Guys, where we speak only about mutual funds. I'm Samir and across is Mahesh. Both Mahesh and I are partners at AMS Investments, which is a mutual fund distributor based out of Mumbai. And we currently manage portfolios for about 100 plus clients. So today's topic, Mahesh, is going to be a continuation of the last topic we discussed, which is why long-term investing is important. Today, we are going to talk about some of the drivers of this long-term performance. What really drives the stock market returns over a 10-year period. But we'll also discuss the factors that drive the short-term performance and why sometimes short-term performance is not a real good measure to understand the long-term performance of equities. So we'll walk through concepts like GDP, price to earnings ratio, stuff that are spoken a lot in the media, but we'll try and break it down for you in simpler terms so you understand how equity markets actually perform over the long term. Mahesh, over to you.
Yeah, thanks, Samir. Last week, we had our video about why long-term, and we used 3-4 different data parameters for that. One, we looked at the 1-year rolling returns, we looked at 3-year rolling returns, we looked at 5 and then 10, and showed how as the time horizon increases, various parameters, including the minimum return that the investor can expect, and the volatility comes down. And therefore, with a longer horizon, you get the benefit of lowered volatility, you get the benefit of a very good return, etc. Now, what we want to do in this episode, I think, is we want to talk about what are the drivers of equity returns in the long run. So you can see here that GDP growth drives earnings growth in the market, and then in turn it drives the returns that the investor gets from the stocks that he has purchased. So higher the GDP growth, higher the EPS growth in the market, and that in turn means higher returns for investors. So this is a clear-cut long-term connection between GDP growth, earnings growth, and stock price returns, right?
I just want to clarify, the GDP is your gross domestic product of our country, India. Earnings growth is the earnings of all the companies in, say, a Nifty 50 index, which is the basket of 50 stocks. These two, the GDP growth essentially drives the earnings of all these companies, and these earnings of these companies essentially drives the equity returns of the market.
The real question any investor would ask, if I just said this, is that, okay, I know that earnings growth is going to be XYZ for this coming year, or that's what everybody talks about. Like everybody says the GDP growth, the real GDP growth in India in the coming year would be closer to 7%. And therefore the nominal GDP growth will be like 12%. Which means earnings growth should be around 12%. And then why shouldn't I invest for the short term for just 1 year, right? Why are you asking me to invest for the long run? So the answer to this, and which is that price of the index or a stock is given by two different things. One is the earnings of that stock itself or the index itself, multiplied by something called the PE. And what is PE? PE is a multiple that people are willing to pay in order to purchase the stock or the index. So the PE is something called the price multiple, and the E is the earnings. So stock price or the index price is equal to earnings per share of the index or earnings per share of that particular stock that you're talking about into the price multiple that investors are willing to pay. Now, this is something that we should remember. This is how we break down the price of an index or price of a stock.
I think, Mahesh, just to make it simpler for people who are trying to understand the concept of PE, a simple understanding of this is, let's say if you have a property worth 1 crore rupees and that property is giving you 10 lakhs of rental income a year. So the price of the property is 1 crore and the rental income is 10 lakhs, okay, which is the earnings of that property. So 1 crore divided by 10 lakhs is 10. So 10 is the price to earning multiple of your property. Similarly, the price of a stock divided by the earnings it generates equals to the price to earnings ratio. I think people might understand that as well.
So now we will look at two scenarios. One is the short-term scenario and second is the long-term scenario. So the first thing that you have to say is Nifty is 22,000. I know it is not 22,000, it is slightly higher, but for the sake of simplicity, let's say Nifty is 22,000. And the EPS of Nifty, that is the earnings per share of Nifty, is 976 as of today. This is the correct number, right? That is what it is. Therefore, the PE, that is the multiple that investors are paying when they buy Nifty at 22,000, as of today is 22.54.
So it's essentially 22,000 divided by 976.
Yes, that's the number. That is the price multiple that you're paying when you buy Nifty at 22,000 rupees today, right? So we have three scenarios that I want to talk about. In the short term itself, three scenarios. One, we have to keep constant the earnings growth that you will get next year, which is 12%, let's say. So this 976 by the end of March 2025 will become 1,093 at 12% growth, right? That's the number of earnings per share that you will see. We don't know what the PE will be 1 year from now. So we will look at three scenarios. One is that the PE remains the same as what it was today.
22.54.
PE was 22.54 today, is 22.54 today. We will assume that PE remains 22.54 at the end of 1 year. Then we look at scenario number 2, where the PE actually drops to 18. And then we look at the PE increases to 25. I've said earnings growth remains 12% in all three scenarios in the short term. 12% is the earnings growth. So 976 rupees becomes 1,093 in all the three scenarios, right? So we have seen earnings growth in the market. What changes is the final PE. So now what is the final Nifty number in 2025 March is the question. If the PE remains 22.54, Nifty price, goes to 24,630 odd, right? That's the price of Nifty if PE remains 22.54. If P drops to 18, then Nifty goes to only 19,674. So that, which means that 22,000 Nifty becomes 19,674 in 1 year's time. So the net return experienced by the investor in the scenario number 1, where the P remains the same, is 12% itself, which is equal to the earnings growth because the P has not changed. When the P changes to 18, that is P falls from 22.54 to 18, then investor actually experiences a negative 10.5% return, creates a situation where the investor loses money despite the earnings growth, right? And when the P increases, obviously the investor makes more money than the earnings growth in the market, which is a great situation to be in. The earnings growth only was 12%, but you actually make a 24% growth because the P also increased from 22.54 to 25. What we are trying to highlight is that the short-term returns, which is 1 year returns, is influenced more by what the PE has done and not by what the earnings growth has done. Because remember, in all three scenarios, we are saying the earnings growth is still the same, 12%. We are not changing the earnings growth. We are only changing the PE. And the change in PE drives the investor returns in the short term.
See, one thing I want to clarify is that PE changes in the short term are driven by events or by news. For example, the Nifty PE in 2019 was perhaps in 22, 23 times. Then suddenly in 1 or 3 or 4 months, the price to earnings dropped because there was a COVID situation that happened in the country, right? So it's driven by short-term measures and short-term issues, and also demand for a particular country's stock markets is also drives the PE. But again, PE is short. I mean, in the short term, PE drives the stock market returns, whereas in the long term, as you will explain, that the PE doesn't draw. I mean, it does impact the long-term returns, but it's the earnings growth that actually matters more.
Yeah. So as you said, short-term PE changes are a function of liquidity, short-term demand supply changes in the market. It could be also a function of whether FIs are buying based on whatever they are seeing internationally, all those things, right? So it's not really a function of so-called fundamentals by which we mean earnings growth itself. So the basic earnings growth is not changing your 1 year stock price changes, right? The PE growth is driving, PE changes are driving the 1 year price changes. Now we will see with exactly the same numbers what happens when we increase the time horizon to 10 years, right? We are keeping the numbers the same. So for example, earnings growth is assumed to be exactly 12% for the next 10 years. So, which is the same thing which we assumed in the earlier situation for the short term. We assumed a 12% earnings growth. Now we assume 12% earnings growth for the next 10 years. And the P changes also, which was, it dropped to 18 and then it went up to 25. All those three scenarios, the P changes also remain the same. So now you can see on the screen what we have done. The earnings growth 12% for 10 years results in the earnings of Nifty going up from 976 to 3025. 3025. So EPS becomes 3025 at the end of 10 years. Now we have looked at the same PE changes. So 22.54 in scenario 1, 18 in scenario 2, and 25 in scenario 3. The net result for the investor is that when the PE drops to 18, the stock price growth that the investor experiences is 9.64% despite a fall in PE. He's seeing a stock price growth of around 9.6%, which is less than the earnings growth, but not as severe as the short-term scenario. And in scenario 3, he's seeing a 13.11% change in prices, whereas in the short-term scenario, the change in price was around 25%. So basically, the P change was impacting the short-term in a very big way. In the long term, the P change doesn't impact the prices in such a large way. It is the earnings that impacts the returns that the investor experiences. So a 12% earnings growth means that the investor in the long run of 10 years experiences returns approximately around 12%.
Yeah.
His returns don't change by a large number. It is around 12%. Whereas in the short term, the returns is extremely volatile, right? It's completely based on what the PE does. In the long run, the PE is almost immaterial, the final PE. It is almost always the earnings growth that is material. So a 12% earnings growth for 10 years drives your returns by around 12% approximately.
This is a good point, Mahesh. One additional point I want to make is that if in any scenario, let's say in a scenario that you discussed, that the 10-year growth is 12% in earnings, then even at the year 10, you can expect that the PE ratio, which you started off with early, and the PE ratio at the end of 10 years will not be very different because the earnings has been sustainable for 10 years.
Yes.
There are very few scenarios where the PE, the price to earning ratio, crashes. Okay. Because the earnings have not transpired over the last 10 years, right? So you might exit, you might get a 18 times P in year 10 or 25 times or 22 times or 19.7 times, whatever, right? And you will still manage to get most of the returns that the index earnings has given, okay? And you've captured a large part of that earnings. So even in scenario 2, the earnings grew by 12%, but you captured only 10%.
Yes.
So you lost 2% because the P went down on year 10, right? But generally speaking, in the long term, what I have noticed is the earnings growth is what is the money that you will make over a long period of time, right? So if 12% is the earnings growth, then you will on average make 12% returns, provided that things are going as well as they have been going on for the last 10 years. This again highlights the shortcomings of short-term investing. And short-term sometimes is 1 year. In my opinion, short-term is actually 3 years.
Even that is tough, actually.
Yeah, 3 years also, sometimes you can have a bad event like what happened in March 2020 when COVID happened. And a lot of people who had invested 3 years before probably saw negative returns, okay? Because it was one big fall that happened in the market. The P crashed completely. Earnings would eventually start to fall, but earnings also recovered post-year once the economy opened up, right? So in the short term, yes, the short term could be 1 year, 3 years also. But 10 years is a fairly good starting point for you to look at equity returns, and longer the better. In fact, if you take this scenario of yours and go this to year 20, and by year 20, the earnings would have been 7,000, 8,000, probably more. Then your returns would be much more closer to 12%, 12 or 13%. Because the earnings have now done their part.
The time, the more your returns will be closer and closer to the earnings growth that you have experienced in that period.
This is why staying invested in equities for a long period of time makes a lot of sense. It's the most boring thing to do, I have to admit. But it is one short way of saying, okay, look, if I do this correctly, then at least I will mimic the returns of the earnings of all 50 companies in the Nifty 50 at least, right? Or at the Sensex. So it's the patience game of this 10 years, 15 years, 20 years that actually lets you generate long-term returns which beat inflation, which is what
Yeah.
our point is from the start, that you need to remain invested for 10 years to beat inflation and to make returns of 12, 13% over that period.
So let me just reiterate what we just said in this
Sure.
video, right? The key points that we talked about. The first point we said was that GDP growth, the long-term drivers of earnings growth in the country is that GDP growth drives earnings growth, and that in turn drives stock price return. That is what we first said. Second, we said that index price or stock price is nothing else but the price of the index into the price earnings multiple, the earnings of the index into the price earnings multiple, right? So we talked about that. Third, we said the short-term scenario, which we used a 1-year time frame, and we highlighted how the P changes matter more for the stock price return or the index return in the short term. The P changes matters more than the earnings growth. The earnings growth was 12% in all three scenarios, but the returns seen by the investor is drastically different based on where the P is at the end of 1 year. Whereas in the fourth scenario, the fourth situation we talked about was when the earnings growth is seen for 10 years, the long term. And we said that the P changes don't really matter because whatever was the earnings growth, in our case, we assume 12%. The returns that the investors experienced in all three scenarios, where the P remained the same, the P dropped or P increased, the returns that the investor experienced was approximately equal to the earnings growth. And instead of 10 years, if I had said 20 years, then you would have seen that the P changes matter even less. So the more the time horizon, the P changes matters very little. The earnings growth matters the most for your returns. So this is what we wanted to highlight in this video.
And practically speaking, most investors, they see the 1 year, 2 year, 3 year performance, and they make up their mind that this is not doing any good to them. And then they fail to realize that it's the long term that actually matters. So you have to have the patience to wait it out for 10 years and see the performance then. Because that is that's the true picture, not the short term picture. It's harder. It's much tougher than said than done.
Yeah.
But this is what we want to encourage people
to. We are going to be talking about that in the coming videos, right?
Videos, yeah. We want to encourage people, and we want to really drive this point down. That look, we really believe that if you are a long-term investor, you will see the benefits. You just need to get rid of some of your biases that you have. And we all have these biases. And we'll talk about these biases in the subsequent videos. So hopefully you'll stay tuned for the next video. And in the meantime, if you have any more questions, please write to us at amsinvestments. Hello at amsinvestments.net. And also, of course, you can subscribe to our channel as well. And please feel free to put your comments as well. Thank you for watching, and we'll see you guys soon.